Price drops first, but it cannot stay low. The session forms inside wide memory. May 26th Asia session forms with a similar size to April 21st US session box. It overlaps that older memory. It does not form as a small clean box. It forms wide. That matters. A wide session gives space. But that space is not always strong. Wide support protects across a broad area, but the line is weaker. Wide resistance blocks across a broad area, but the reaction can be messy. Narrow support can be tighter. Narrow resistance can be stronger. That is why box width matters. May 26th Asia session forms with enough width to create movement inside the box. Price first stays inside May 26th Asia session box. It rotates. It moves down. It does not immediately expand. It does not create clean direction. Then price reaches April 20th US session upper boundary. That is the first important test. Price moves down into that old memory. It touches. It reacts. It cannot keep falling. The downside loses control there. That is where the long starts to appear. Not because price is already strong, because sellers fail at an older boundary. That matters. The long is not a chase. The long is a response to failed downside pressure. Now price begins to move up. It returns through the structure. It pushes toward April 21st US session upper boundary. That becomes the target. The move is not random. It starts from April 20th US upper memory. It aims toward April 21st US upper memory. Old session memory gives both sides. Entry. Stop. Target. That is how the trade becomes visible. Long entry line. April 20th US session upper boundary. Stop loss line. April 20th US session midpoint. Take profit line. April 21st US session upper boundary. Risk-reward ratio 2.48. The entry sits at April 20th US session upper boundary. Why there? Because price drops into that line and cannot stay below it. If price had broken below it and kept distance, there would be no long. If price had moved sideways without reaction, there would be no clean entry. But price reaches the line. It reacts. It starts to move away. That creates the long. The stop sits at April 20th US session midpoint. Why there? Because the long uses April 20th US upper boundary as support. If price returns all the way back to April 20th US midpoint, the upper boundary hold has already weakened. The trade has lost too much control. The move has returned into balance. That is where the long idea is damaged. So the midpoint becomes the stop line. Not because it feels close. Not because it improves the ratio. Because the structure changes there. If price reaches the midpoint, the long no longer has the same reason to exist. You leave. No argument. No hoping for one more bounce. The target sits at April 21st US session upper boundary. That is where the move can complete. Price is moving from one old US memory toward another old US memory. That is the structure. The target is not chosen because it looks far. It is chosen because price has a reason to react there. If price reaches that boundary and stalls, the trade has paid. If price reaches that boundary and keeps distance, a trail can be studied. But the first job is simple. Take the clean target. Do not turn every long into a trend prediction. Now look at the risk-reward. 2.48. That is usable. That gives the trade room. The reward is large enough to justify the stop. The entry is not too late. The stop is not too deep. The target connects to old memory. Those three lines fit together. That is why the trade can be executed. Now compare trader types. An aggressive trader may tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes price never touches that tighter stop. The trade pays faster, but the danger stays real. A tight stop can be touched by normal reaction. The direction can be right. The position can be gone. That is painful. You read the structure correctly, but you cannot collect the move. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. The chance of losing the position before the target decreases. But the wider stop must still pass. The risk-reward test. If the wider stop destroys the ratio, the conservative answer can become no trade. That is not weakness. That is account protection. Now trailing. Trailing is not automatic. A trade must earn the trail. If price reaches the first target and stalls, take the result. If price reaches the first target and holds with distance, the remaining position can be managed. A practical trailing interval needs space. About 0.5 risk-reward unit or more is a useful minimum. Less than that often becomes noise. If you trail too early, you suffocate the position. If you trail too late, you give back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too close. If normal reaction touches it, the trail damages the trade. If the stop stays too far away, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price keeps holding distance, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But numbers do not create the trade. They only manage a trade that already has structure. May 26th, Asia gives the clean lesson. The session is wide. The support is wide. The reaction must prove itself. Price reaches April 20th U.S. upper boundary. It cannot keep falling. It returns. The long forms. The stop sits at April 20th U.S. midpoint. The target sits at April 21st U.S. upper boundary. Risk-reward ratio 2.48. The trade works because old memory holds. The move pays because the target is real. The entry comes before the obvious recovery. Price reaches. It reacts. It holds. Then, the long begins. Price holds the lower side, but the trade still fails the test. The session forms inside expanded weak memory. May 27th U.S. session forms almost aligned with May 26th Asia session lower boundary. It expands to about 200% of April 20th U.S. session box. It overlaps. It forms wide. That matters. A wide box gives wide movement. But wide movement does not always give clean execution. The lower memory underneath is too spread out. Support is not tight. Reaction can move deeply. A stop needs more room. A target needs more time. That is where the problem starts. May 27th U.S. session tests its own lower boundary. Price moves around the lower side. It stays inside the box. It does not leave with clean direction. It touches. It reacts. It returns. It does not build stable distance. A long setup can be drawn, but drawing a setup is not enough. The trade still needs quality. Long entry line. May 27th U.S. session lower boundary. Stop loss line. May 27th U.S. session lower boundary. Minus 125% area. Take profit line. May 27th U.S. session midpoint. Risk-reward ratio. 1.8. At first, the trade looks possible. The number is not terrible. The line is visible. The target is clear. The lower boundary gets tested. So the hand wants to enter. But the structure is not clean enough. The entry sits at May 27th U.S. session lower boundary. That can work only if price holds there and moves away. If price only rides the boundary, the long becomes weak. If price cannot create distance, the trade becomes slow. If reaction comes back fast, the stop comes under pressure. This is where the chart starts warning us. The lower support area is too wide. The old session memories below are not tight enough. There is too much empty distance between meaningful supports. That changes the stop. If we want a safe stop, the stop must sit deep. But a deep stop changes the trade. The risk becomes larger. The position size must become smaller. The target must move higher to keep the ratio alive. And when the target moves higher, the trade needs more time. More time means more exposure. More exposure means more risk. The trade may not lose immediately, but the account stays under pressure longer. That matters. A trade can look good on the line, but bad in time. A target too high can trap the trader inside waiting. The position stays open. Reaction keeps coming. Price rotates. The trader loses patience. Then the trade becomes emotional. That is why this long should be skipped. Not because the entry is impossible. Because the full structure is not good enough. The stop is too deep. If we protect the real structure, the target becomes too high if we force the ratio. The time risk becomes too long if price moves slowly. That is not clean execution. That is forcing a trade. Now look at the session width again. Wide session boxes create weaker support and resistance. The boundary is not sharp. Price can move around it. It can pierce. It can return. It can test again. That makes the stop harder. A narrow box gives a tighter decision. Price either holds the line or fails quickly. A wide box gives a broader fight. That can be useful for larger trades, but it can be dangerous for 1-hour execution. May 27th U.S. session is that kind of danger. It looks tradable, but the support under it is too wide. The reward does not compensate enough. The time pressure is not favorable. So the better decision is no trade. Now compare aggressive and conservative behavior. An aggressive trader may still enter. They may tighten the stop. They may increase size because the stop distance is smaller. Sometimes price never touches that stop. The trade can pay, but the danger is clear. A tight stop inside a wide box can be meaningless. Normal rotation can touch it. The trade can still be right later, but the position is gone. That is not structure. That is impatience with a small stop. A conservative trader looks deeper. They ask where the structure actually fails. They place the stop below the true support area. Then the risk becomes too large. The target must become too high. The waiting time grows. So the conservative trader skips. That is the better answer here. No trade protects the account. No trade protects the next opportunity. No trade protects the method. Now, trailing does not matter if the trade should not start. That is important. Many traders want to solve a weak entry with clever management. But management cannot fix a bad trade selection. If the entry is weak, the trail cannot save it. If the stop is too deep, partial profit cannot fix it. If the target needs too much time, a nice plan cannot remove exposure. The decision must happen before entry. Does the line hold? Does the stop make sense? Does the target pay? Does the trade have time? Here, the answer is not clean. So we wait. Now connect the movement. May 27th U.S. session forms wide. Near May 26th, Asia lower boundary. It tests the lower side. It stays inside the box. It offers a visible long. Entry. May 27th U.S. lower boundary. Stop. May 27th U.S. lower boundary. Minus 125%. Target. May 27th U.S. midpoint. Risk-reward ratio. 1.8. But the support below is too wide. The safe stop becomes too deep. The target becomes too high. The trade may need too much time. So the trade is skipped. That is the main lesson. A visible setup is not always a tradable setup. A risk-reward number is not always enough. A line can hold and still not deserve entry. Now the larger charts matter. If this movement is confusing, go back to monthly, weekly, and daily structure, especially the weekly chart. The weekly chart must be visible before every serious trade. The 1-hour chart gives the entry. But the weekly chart tells you where the market is trapped. It tells you whether price has room. It tells you whether the target is realistic. It tells you whether the trade is fighting a larger boundary. Monthly gives the field. Weekly gives the pressure. Daily gives the working range. 1 hour gives execution. If the 1-hour setup looks unclear, the answer is not to force a trade. The answer is to step back. Look at the larger boxes. Look at where price is sitting. Look at whether the next target has space. Look at whether the stop is too deep. That is how daily movement becomes understandable. And that is why weekly analysis matters. The daily chart can show the rhythm. The weekly chart can show the wall. The monthly chart can show the battlefield. When those frames align, the 1-hour trade becomes cleaner. When they do not align, no trade often becomes the best trade. May 26th gives one clean long. May 27th gives one tempting long. The first one works because risk and reward align. The second one should be skipped because the box is too wide and time becomes risk. Same market, different quality. Price reaches. It reacts. It holds or fails. Then the trader asks the final question: does the risk deserve the reward?